All right, everybody. So this is going to be the second setup on the short side that we're going to be going over. It's the upthrust. All right. So I'm going to be going over this, and I'm going to then maybe go into like the detailed implementations on exactly the operating procedure on exactly how to execute. All right. That's not even in this book. It's not. I mean, it's a little bit vague because the exact step one, step two, step three, that type of operating procedure is required in order to trade. Otherwise, it becomes just reading a book or more of an academic exercise about what this is and what that is. But we're not interested in that. We want to be able to execute. So I'll go into execution maybe in the next video, because I don't really see it here. I mean, it's to some degree it's there, when the price goes back in the range and all that, but specific execution for intraday trading using a higher time frame and a lower time frame is not there. It's more like, trade the spring when it comes back within the range and takes out the high, and then put a stop under the spring. But if you want to get a little granular, maybe I'll do that next time. All right, but the key points are here and the guidelines are here. So why this is important is because this is a setup. I mean, if you want to have the setup in order to trade on what should happen on a higher time frame, either break and test, or a spring or an upthrust. Done. Once that occurs, you need to go into the lower time frame and check for buying. So anyway, so let's go over upthrust. So I went over springs, and also before I go any further, I want to just show some real practical examples so you understand this is not some bullshit. All right, so today, and this was executed, is real trade. Was I? So there was a spring on the ES, very easily. And how you do this: combine two time frames. So one is the hourly and the other is the 5-minute. It's very easy. You have two charts ready to go. All right, and I'll just show it. This is your range. You see the range? This is a whole range right there. Right? This is the range. This is the low. Now here's the thing. The first break here and the second break here, to pay attention and watch the red bars. So the first break offers a retest trade, all right, meaning it broke and then it retest and gave a trade, and it seems small, but you have to understand that on the lower time frame this is a good move. It seems small on a higher time frame, but the lower time frame you get in, you get a good move. All right, now before we go any further, tell me, what is the difference between this red bar and that red bar? And the key point here from the explanation I did on springs from the book is follow through. So the logical question is, what the hell do you mean by follow through? Right? Because we say that spring and upthrust, they're basically breakouts without follow through, meaning they break the range high and low, but they have no follow through. So what is follow through? Here's the answer. If you take a look at this red bar, this break, what do you notice right after it? You notice a second red bar. The red bar is followed by a follow-through red bar that makes lower high and lower low and lower close. That is clear follow-through. Sometimes it's enough for it to be a red bar, right? Meaning it's not buying, it's not green. Right? Follow through is follow through selling, and having a second red bar means there's selling. Now, if you take a look at this red bar, it turned out to be a spring. Why is it a spring? It has no follow-through. How do you know it has no follow-through? Do you see a red bar after it? The answer is no, it's a green bar. What about making a lower high and a lower low or a lower close? It makes a lower high, it's inside, but it does not make a lower low. Problem. It's not a red bar and it doesn't make a lower low. Problem. It does not qualify as a follow-through bar. A follow-through bar is either a red bar, and this is actually from my experiences, so I know what this stuff is. All right, so follow-through means it's follow-through selling, and there's no evidence that this green bar is follow-through selling. If I showed you this red bar and then I showed you the green bar after it, would you say this follow-through selling if you saw an inside green bar? No. But if you see this red bar, it is a lower close, a lower high, a lower low. Clearly there's follow-through. All right, so that's the point. That is follow-through. And that is the key distinction between the success or failure of springs and upthrusts. Springs and breakouts require follow-through. Springs and upthrusts do not have follow-through. I know that they're, they talk about like high volume and low volume and all that. Truth is, whether it's high volume or low volume, the thing you need to look at is follow through. All right, you could have high volume spring and low volume spring. It doesn't necessarily need to be a low volume spring or an upthrust. I've seen all the time fake outs. Fake outs are breakouts with high volume. They look like breakouts, but they have no follow through and they go back into the range. That's the other point, going back into the range. So when we take a look at this, what do we notice? We notice that it broke, came right back within the range, meaning above the prior low. And as it did that and had no follow through, again, came back within the range, had no follow through, it qualifies as a potential spring. But there's one other thing that you need to see. You need to go to the lower time frame and validate the buying to see if it's aggressive buying. So 3 things. 1, no follow through. 2, goes back within the range. And 3, lower time frame buying. All right, aggressive buying. So let's see, is there aggressive buying? This is the spring. That red bar is this wave. Now, we will see how the response is to that wave to determine whether it's aggressive buying. Take a look at this wave. Is this aggressive buying? Well, let's take a look at just its price and time characteristics. This is the biggest up wave in 17 waves. Does this look like a weak response? Or does this look like someone's buying that break? Someone's buying that break because this is the biggest up wave in 17 waves, up waves, and it is aggressive buying because it's the big up wave. Secondly, it lasts long time because it lasts for 30 minutes. It's more than the prior 1, 2, 3 waves. So it's sustained buying. You have sustained buying on a big wave coming from a breakdown attempt, which tells you that the breakdown is failing because it is being bought. Done. And look what happened. You got the pop right there. So once it does that, time to get in. All right, so I'm literally showing you exactly what to look for on a fake out. All right, I'm done with this. That was the opportunity today on the ES. Now we're going to take a look at up thrusts. Again, this is no rocket science, pretty much the same thing upside down. All right, so I'm not going to spend that much time on it. We just need to go through it. All right, consider the potential for a downward. Okay, so when a stock or index commodity moves above a previous line of resistance and fails to follow through, again, it does not, you have a green bar breakout, and the bar after it should also be a green bar, or at least make both a higher high and a higher low. If it does not make a higher high and a higher low, and it is coming back within the range, you got problems. If it's not a green bar, if it's not a follow through green bar, it's problems. So one has to consider the potential for downward reversal. Such failed breakout is called an upthrust. A failed breakout, a fake out, is called an upthrust. Like a spring, it can occur in several ways, and it may be retested at a later point. Like a spring, it offers a trading opportunity at the danger point where the risk is the least. Again, low risk trades. This is what you want to go for. Why is it low risk? Obviously, it's at the edge of a trading range, so it's low risk because it's coming back within the range. So it has to be low risk because you're just risking the, in a case of an upthrust, you're risking the upthrust high, right? It similarly can, meaning the stop is above the upthrust high. Coming back to this, it similarly can provide a very fast trading turn. Just like a spring or upthrust, it's fast. You don't want to wait there. You don't want to wait, it's dingle dangle, it's not working. And we need quick moves because you don't want to wait all day for a trade to work out. So this is a fast trading opportunity. I find upthrusts to be more difficult to trade than springs. The reason he's saying this is because he's trading this in against trend. If you trade upthrust against trend, you're going to have problems. Meaning, let's say you make a higher high, but it's a weak higher high, and you think it's an upthrust, and you put a short on it, there's a problem. Why? Because there's always there's a lot of folks that buy new highs. More buying of new highs than selling of new lows. You see? So the upthrust that looks like a shortening of the thrust, when it's not a good idea to sell it, you're going to lose money. What you want is basically a breakdown, a downtrend rally, a down rally, right? Downtrend, a down rally and a downtrend, and then pulling back and giving you the upthrust opportunity. Do not try to shortening of the thrust trades, because the shortening of the thrust trades within trend are basically upthrusts. But the problem is that they don't work as well. And he's saying the same thing. I tried upthrust to be more difficult to trade. He found upthrust to be more difficult to trade than springs, and it's the public willingness to buy new highs. That's why. So there's like an extra edge for buying new highs than it is for selling new lows. They are not anxious to go short on new lows. There you go. But they are anxious to go long on new highs. Thus, we often can discern the professional buying more clearly on a spring. Professional selling at the top may be obscured under cover of public buying. That's the preferred environment. Because of the potential for an upthrust, I'm not eager to buy breakouts. Yeah, don't buy breakouts because you could be in an upthrust. All right. So how do we know whether a breakout will be a fake out? The trend is the most important consideration. All right? Here you go. Do not sell up thrusts in an uptrend. Why? As will be shown, up thrusts in an uptrend rarely work. They rarely pan out, so don't do it. In a downtrend, however, up thrusts above a previous correction high have a great probability of working. This is the ABC pattern, meaning you have a down rally. Imagine a bear flag, right? You have a down rally, then you have pullback A, down B, pullback C. C is slightly above A, sets up the up thrust. So it's just the ABC pattern, corrective pattern. That's the type of thing that you want to look for. All right. Do not try to sell shortening of the thrust in an uptrend. Instead, wait for a downtrend and then start looking for up thrusts. There are almost an infinite way up thrusts can occur. The first prerequisite is a previous high across a resistance line is drawn. So just draw the line. All right. Just find a high and draw the line. All right. And a move above that line becomes a potential upthrust. Okay, a potential upthrust, meaning it's in upthrust position. Just like when a low is below a support line, when price just dips below the support line, it's in a potential spring position, right? So you have potential. Right? You don't know if it is or isn't. You have to wait for the action to occur, meaning it has to come back within the range and have no follow through. The rise above a previous high may not be the deciding price action. It is often the cumulative behavior of the price bars, especially the succeeding price bars, that tell the story. The succeeding price bars, what do they need to do? No follow through. That's the key. No follow through, come back within the range. Upthrust can occur in any chart regardless of the time period. When a market records new highs, the volatility becomes greater. All right. So in such environment, an upthrust on an hourly chart can produce a down move that's quite large. Okay. You see this? Don't do this. Do not sell right here. This is the upthrust and shortening of the shortening of the whatever. What is it? Shortening of the thrust trade. This is the bad one. Do not do this. Why? It'll pull back and just get bought again. Do not do this. Which one do you want to do? This one. Why? It's in this area that you have selling in the background, and it forms an A, B, C. So in this area is what you want to do is look for the sell. Not in an uptrend, bad. Here, after the selling, after a break of a low, then on the pullback, look for the upthrusts. So I'm being very clear here. Selling in the background, meaning you have a down rally, then you have pullback A, B, C, look for it on C, and then you have to know where to put your stops. And that's it. This is another sign of an upthrust. This also I'm not a fan of, but there's selling here. And this is not exactly an uptrend, it's a flat trend. So if this was an uptrend, it would be a problem. These are again high. Right? This actually I don't like because this I see as a rally, pullback, rally. And now you're shorting the retest of the rally high. So rally, pullback, rally, attempt above that high and trying to short it. This you can get really hurt on. It would be a much better idea to, after this break, right? You have this break, you have this up, down, up. This right here, this right here, I think is an upthrust of the prior highs just by a few ticks, right? And you have some selling in the background, meaning you have this breakdown below this low. So that's a much better opportunity. Here's a key point. The S&P is notorious for springs and upthrusts. This is why you want to trade springs and upthrusts on a market like the S&P. So the ES traders, this is good for you. All right? And it's also the case of intraday, not just, daily charts. Also on gold, I think there's some traders that use it on gold a lot. And what I showed earlier on was on the S&P. So that's the trade that happened today. Never do this. It's fine you draw the range, but do not short these high. This is a problem. You should instead look for springs. So for example, this right here, spring opportunity 1 right there. See that pullback against this low? Spring. Here again, you have up, down. This is the first pullback leg. Second pullback, boom. Right here is another opportunity. Again, here, there's a small one here. I'm not sure if I see it here. Not here. It's like 2 or 3 in this uptrend. Spring, not those upthrusts above those highs, because look at the move. It's like crap. I am not going to go all the, notice bar by bar, this behavior, that behavior. You don't need to. I think it's very impractical to do daily bar by bar behavior because you're going to get paranoid about the position. So, and especially intraday is probably the worst thing you can do is read bar by bar. I know it's all these guys, they try to read bar by bar, but it's not going to help you if you read bar by bar. All it's going to lead to is exhaustion, and it's also going to lead to errors in judgment. So the idea of reading psychology on bar a bar and reading every bar, it makes no sense. It's much better just to draw the lines and wait until price is at those lines to see the behavior you need to see in order to take the trade, versus reading every bar by bar throughout the entire day on the edges and within the ranges. I mean, you're going to read every bar? You go crazy. So it's unpredictable because within the ranges, there's a lot of craziness and the myriad of patterns. So it makes no sense to make it even more noisy and read it on a bar by bar basis. Here, we're coming back to here where it says chapter 3 dealt with importance of framing trading ranges with support and resistance lines. This is the key. It's around these lines that upthrust and springs occur. Step 1, draw the ranges. Step 2, pay attention when price is at the edges and touches these lines. Step 3, look for a breakout, and to see if it's really an upthrust or a spring on, the lines. How do you know? See if there's follow through or not, and whether the price goes right back within the range. And if there is heavy buying in the case of a spring on the lower time frame, or heavy selling in case of a spring, in case of an upthrust on a higher time frame. How do you quantify it? The size of the wave can be used. What else? Heavy volume, so you might have wave volume, and even time, the length of the wave. Is it 30 minutes, 40 minutes, the duration of the wave. See this upthrust? You have to know what you're doing to do this, because you have an uptrend, right? So your mind should be focused on springs. Retesting this here is this type of trade is harder, because he even mentioned that, you have new high buyers, this new high. So amount of pullback, who knows? So it's better to look for springs. Once the spring occurs, look for its test, or for the spring to get sprung again. It's a possibility to get sprung again. All depends here. This thing is not showing it, but on the lower time frame, you'll see it. The vigor and strength of this bar is clearly indicated in the wave on the lower time frame. Again, you don't need to read all of these bars like he's doing the study, but you don't need to do it. It's much better just to wait for price to be at the edges. Trying to read every bar, it's like a pointless activity. You're not even going to trade it. So it's not, you're not going to trade until it gets to the lines. So that's where you start observing, and reading. In summary, the trend is of paramount concern when evaluating upthrust. Again, make sure the trend is on your side when you're trading upthrusts. All right. And yes, you should know like the price volume behavior of what happens before the upthrust, but that can be observed when the price is at the resistance level. You don't have to sit there and watch every single bar form. All right, the next one here, we've gone through upthrusts, and really to understand this, you have to go through what I did on springs, and upthrust you see is just the opposite. All right, and that's about it. Now the rest of these chapters go into absorption. I don't trade absorption. I don't recommend trading absorption. All right, maybe someone knows how to do it, but you just need to recognize it. Even if you don't trade it, you just need to recognize it, because it's telling you it's going to bust through the range. So we're not really going to go into absorption. Basically, it's really straightforward. If price is at a support or resistance level, in this case, if it's at a resistance level and it's hugging it, not reacting, it's just hugging that price level, chances are it's going to break through. So that really is it. I mean, they're using all these other tests, but really the descriptor here is it hugging the line? Meaning it can't rally away from the line. It's hugging it. It's going to break through. So it looks like a bunch of bars that are sequentially placed, or are hugging, or are within that same range, right, together. And that really means that, it's just absorbing the supply and it's going to bust through. I think that's enough, because just to make it practical again, right, let's revisit some key ideas here. All right, so let's review some key ideas here. And this is going back to where to find trades. All right. Where to find trades, they're circled. All right, so we're going to look at where the circles are, and that is where to find trades. Before we do that, whenever the boundaries are breached, the follow-through or lack of follow-through becomes the deciding factor. After breakouts or breakdowns occur, prices often retest these areas. So let me just bring out the note. All right, so the first thing is, let's go over some of the stuff. Draw the lines. Second is pay attention when you have a breakout or breakdown. What do you pay attention to? And what's the key question? Is there follow through? In the case of breakout, is there follow through buying? In the case of a breakdown, is there follow through selling? B, let's say there isn't. Does price come back within the range? So let's just say the first answer is no. Does the price come back within the range? Yes. C, let's make this case of a spring. All right. Let's say you have a breakout. Scenario, the breakout is an upthrust. Okay, so in this scenario, is there follow through? By follow through, is there follow through buying? Meaning a green bar after the breakout, or at least a higher high, higher low bar after the breakout. If there isn't, if the answer is no, there's a problem. Second, does price come back within the range below the resistance level? It does. Is there heavy selling, which is on the lower time frame? How do you determine this? Heavy selling wave. B, big down wave. C, lasting down wave, meaning it lasts, say, 30 minutes, 40 minutes, etc. in an intraday context. Is there heavy selling? And if, these are the criteria. If the answer is yes, then conclusion, the breakout is an upthrust. just reverse this for a spring. All right. There you go. All right. Now let's go back into this. So he mentions, follow through is the deciding factor right here. The lack of follow through becomes the deciding factor. Whenever the boundaries are breached, follow through or the lack of follow through becomes a deciding factor. All right. So let's come back and see what he has here. We see the first thing he did was draw the range. And we see the price is swinging back and forth within this range. As it comes here, this is actually an upthrust of this high. By the way, the circles offer the trading opportunities, okay? So price makes a rally high. So as the market is swinging back and forth, look, the circles are where the opportunities are. So what do we notice? We have a high. We have a rally high, and we have a retest of that rally high. That's an upthrust with a slight penetration, offering the opportunity. But do not do this, all right? Because rally, pullback, and then you have that second pullback. This is probably the better opportunity, is that spring to take it up to the new high and get out. Shorting the high, retest of the high like that, you really need to, I'll tell you when it works, okay? This factor is critical in that situation. If you're gonna do that, you better make sure, actually you need other things too. On that retest, right, it should be like this. So that's it, the high. And you go over here and it does this, right? On a lower time frame, this area, if you're going to short it because you think it's a potential upthrust, and very well might be, first of all, understand the pullback is going to get bought around here. So the move here better be worth it. Second is, when it comes over here, it needs to build volume. There needs to be some type of block of distribution over here. So typically, you need that. And the third thing is you need a pretty strong heavy selling wave. All right, but it shouldn't get into an oversold position, meaning it should be like this. This wave should be on a lower time frame, would be like that. It should not overshoot. If it overshoots, it's going to be in an oversold position. They're going to come back in. And then, you can take it all the way down to that area. Be very careful around here. It's going to get bought and it's going to go. So you're trying to trade that piece against a prior high, seeing if you got like a little upthrust here. All right, so we did this type of trade, but do not take the shorting of the thrust trades if you don't know how to. And even so, chances are it's not going to go that low. It's just going to go right here and get rebought. This one here is an upthrust. Again, I'm not a fan of like at the edges like that, because I just explained to you, look at the rally wave in the background. So what do you think is going to happen? It's going to get bought. It's definitely going to get, it's a buying pressure here, maybe buying pressure in the middle, right? So not a good idea. Over here, you have the internal waves. Here you can actually, if you have selling in the background, if you have this situation where you have that and you have that upthrust on the test of a breakdown, that's good. Because you have selling in the background, you have a breakdown bar, you have a test and a retest and all of that. So this is the better upthrust to look for. The A, B, C. So we see the spring and the up thrust, etc., etc. We also see the rally pullback trades. Look, rally pullback, rally pullback, rally pullback. So this is the typical one that you all know of. Rally pullback. And also what I mentioned is if you don't have a lot of thrust, then the pullback will go below the prior rally high into an internal high. Tap it on an internal wave and then go. So just know that the amount of thrust indicates the amount of pullback, and if there's not a lot of thrust, it's going to go tap an internal high and then break out. And anyway, so there's nothing else. There's the absorption, but I'm not going to go into absorption trading. I don't think it's needed. We're just focusing on the up thrust trade, the spring trade, and the break and test. What do you notice about break and test? Break and test is the first leg, right? That's what he's showing. The the spring trade is going to require at least 2 legs. The retest requires 3 legs, A, B, C, D, E. All right, so that's all you really need. You don't really need anything else, right? Meaning in terms of setups, this is enough. Break and test, you know, it's always there. And then you have the spring and potential retest of the spring. The absorption trades, I don't really see them as necessary. And you see again, look at what he's doing. First step, frame the range. The other thing here, he doesn't really frame the channel, but you should frame the channel as well. Frame the channel, because when price starts moving away from the top channel, it will show you a shortening of the thrust. Like around this area, for sure, the channel would indicate a shortening of the thrust. All right, so you have rally, pullback, test of the breakout, another test of the breakout, all of that. All right, so again, what you've learned from this here is draw the lines. The lines will frame is planning for where to look for trades. When you get springs and up thrust and test of breakouts, and that's it. You don't really need anything else. Those are your 3 setups, basically 2 setups, which is on the spring or up thrust, or the test of the breakouts. There's one variant, which is the test of the spring or the test of the breakout. All of them are across the support and resistance lines, so draw your lines. And this here is what I'm showing you. It's a little, I don't know, checklist. You know, is there follow through buying? If not, the breakout is an up thrust. Possibly. Does the price come back within the resistance, underneath resistance? Yes. Is there heavy selling on the lower time frame? Yes, they're selling the breakout, which makes it an up thrust. Apply the same logic on the springs. And the same logic. Instead of heavy selling wave, you would have a heavy buying wave. All right, folks, that's it. That's all you really need to know. There were some other studies about, I don't know what else are there. Chart studies and this and that. In my opinion, unnecessary. Why? I don't really care to read every single bar because I'm looking for trades at support resistance in those positions. So unnecessary to read every single bar because it's not relevant. All right, and so channels and support resistance lines, and then observe the behavior there, look for the setup, and execute. Point and figure, you don't need it. All right. You don't need it. It's good to have. You can do point and figure calculations or just use other support and resistance levels to to take trades at. The other thing is tape reading part 2 has to do with waves. I'm not going to go into the waves, but there, if you want to know about the waves, there David's webinar is on Big Mike, and the other one is on YouTube. Just look at that. But the heavy buying and selling wave, this condition requires you using the wave chart. It doesn't require you using, but it's good to use the wave chart to see it clearly. And point and figure Renko, I'm not going to go over it, but if you do want to know about Renko and what David's work with Renko was, you can easily go and see on YouTube. He did a collab with Linda Rashke, I think, with the Renko webinar, and it's pretty detailed. So you can go and take a look at that. It's actually more detailed than this chapter here. So I'll point you to the webinar. And that's it. So keep it simple, keep it straightforward, focus on the setup and executing the signal, and then you have to have an entry procedure. The stop, okay, let me just go over this. This is important. Right, so let's say you have this upthrust occur. All right, say so let's just go over this. So this is, let's say, we'll just call it an hourly chart. With hourly chart, you get plenty of trades. You get a trade at least every day. And your 5-minute execution. Right? And this leg looks like right? So you have the selling wave here that breaks. Where is the stop now? The stop is up here. You want to wait for a pullback and a reversal to take the trade. Okay? But the stop is going to be considered here. Is there a chance that the market may do this and cause another upthrust? Absolutely is. So you have to look at your lower time frames and analyze the selling wave. All right, analyze that. Yeah, it went right. The other conditions of the, the selling wave took the price back underneath the initial resistance area. The resistance area shows an attempt above, but it had no fall through. Good selling wave, has some bars over here overlapping, which shows resistance, and then being able to take this turn for a move down with very low risk and big reward. All right, I'm not going to go into anything else. What I'll do is I'll start showing daily springs and upthrusts. Maybe that'll help clarify things even more. All right, take care. Have a good day. Bye.